Welcome back. This is stock market terminology, and it's good to know this part because when you're watching CNBC or you listen to the analysts speaking about the stock and the market and how it's going, they're going to be using certain buzzwords. So let's find out what those buzzwords are and what they mean, and that will help you make better decisions, and then you will also understand what they're saying. The U.S. stock market for us opens for trading at 9:30 in the morning and it closes at 4 p.m. So it's good to know the operating hours, but it's also good to know the after market hours because your money is still moving. Your money is still moving. Even though the market's closed at 4, your money is still moving because you still have a different group of people who are in there buying and selling. So we have 3 major U.S. stock market indices. Can you guess what they are? So if you guess, we have the NASDAQ. I'm sure you've all heard of the NASDAQ, right? We also have the S&P 500, which is Standard & Poor's 500. And then we have the Dow Jones Index. I know you've heard of all 3, but what do they actually mean for your money? Let me tell you. Okay, the first one is the NASDAQ. The NASDAQ is like my favorite, right? It has like more of your technology stocks and more of your newer age stuff. So most of the things I trade will be on the NASDAQ. So I look at the NASDAQ very closely. Now, it's the second largest exchange behind the New York Stock Exchange. And they do everything electronically, whereas the New York Stock Exchange still do like paper stuff. Like if you ever watched Trading Places with Eddie Murphy, when you watch that movie, although it's a comedy, it does tell you how to buy and sell stocks and what they mean, right? So it's a good movie to watch if you want to laugh and you also want to learn. Now, so with the NASDAQ, you have things like Google, Amazon, Microsoft, Apple, Tesla, all that. They can be on the NASDAQ. Now, your Standard & Poor 500, S&P 500, what it does is it's in the name. Even though it says poor, there's nothing poor about them, right? But they're the largest 500 corporations. And these stocks can be listed on the New York Stock Exchange along with the NASDAQ. Because just because you meet the criteria for one, you can also meet the criteria for the other. So let's go over the other 2. Now, the Dow Jones to me is more like the old money stock, right? People have been having money for a while. These are the things that's been around for a while. And so that's what it reminds me of the Dow Jones, right? And what it's going to do is list the top 30 largely publicly traded companies and corporations. And it would include things like GM, Nike, Walmart, McDonald's, been around for a long time. You'll normally find them on the Dow Jones Index. Now, there is another one that I'm sure you're familiar with that's not listed, but they're also part of the exchange. They're called your penny stocks, right? They're not listed on the exchange. They're normally like smaller companies, and they're riskier because they do not meet, remember this, they do not meet all of the strict guidelines to be on the exchange, which means that if they don't meet all these guidelines and all the protocols and all the checks and balances, they cannot be listed on the exchange, but they can be listed as a penny stock. Now, the most important thing to remember is that although they're penny stocks, the higher the risk, the higher the reward. And we'll go over that too later on. Now, penny stocks are not what you really believe. They're not just penny stocks. Any stock that can be under $5 can be listed on the penny stock. Better yet, the bulletin boards are over the counter, right? So just because it says it's a penny stock, it may be $3.30, it may be $4.75, but it's under $5, so it's still considered penny stocks. Now, we already said that penny stocks are less than $5, right? And they're going to be on an over-the-counter bulletin board, or which sometimes they call it pink sheets, right? It's like your over-the-counter medication. Like all the good stuff, all the important stuff, or whatever, is going to be behind a prescription. Behind a pharmacist, right? The glass and everything is protected. But then you got your stuff on the over-the-counter, which anybody you want to try, anybody can try, right? And that's what over-the-counter stocks are pretty much. They're like your ones that anybody can have those. They're not meeting criteria. We don't know what's going to go on. And a lot of times with your penny stocks, when you're over the counter, is when you can make your most money. I know when I first started day trading and trading in 2008, take that back, because I started stock trading in 2008. I didn't start day trading until 2010. But when you're looking at certain stocks, for example, I made a lot of money in the beginning off of pharmaceuticals because pharmaceuticals can sometimes, it's like trial and error. they're doing their research and development, and they have to go through FDA phases. So for example, if you have a drug that says, oh, it's going to cure short people, which is me, I'm only 4'11", right? We're going to cure short people, make you 5 feet from 4'11" to 5 feet overnight. Okay, so now they got this little drug and they're working on it, going to go ahead through FDA process. And the FDA may say, okay, phase 1, we did some trials and clinicals, and I think you're okay, so now you can go to phase 2, right? Now that stock may start off at like 25, 30 cents, or even $1 or whatever, anything under $5 it may start off as. Because they're still going through the process. They're not meeting all the guidelines of the New York Stock Exchange, but they're still a legitimate company. You will find some illegitimate companies. That's why they're not meeting the guidelines. But you will find you have legitimate companies that are going through a process. So with pharmaceuticals, for example, I had bought one, it was like 5 cents a share. And I'm like, oh, okay, let me go ahead and buy some, right? And they were at like FDA phase 1, then they went to 2, and it took like a year. It took a year. So it wasn't, when you're buying stocks, remember, it's not about you making money right away. This is your long-term gain. So which means if you start day trading, or if you have a job, or if you have a sidekick, or you have retirement, or whatever, that money can still grow for you. But the stock market is for the long term. You're not buying stocks so you can go ahead and cash out tomorrow, right? This is a long term. So just think back, like if you would have bought Apple when they first started, if you would have bought Netflix when they first started, if you would have bought Amazon when they first started, if you would have bought Google when they first started, right? They all started at a very low price. It's that you got to make sure that you're picking the right ones. So I had bought it for like 5 cents. It was a drug. And before you knew it was like $30. I was like, I'm selling this. I am selling this, right? And when I sold, I finally got out at like $27, right? And I was like, oh my God, right? So then I looked around and went up to like $57 a share. I'm like, oh shoot, I got out too soon. And this is how the market works, right? And so I made my profit, and I still kept kicking myself. And that's what you don't want to do. You don't want to go back saying, oh, I should have kept that, or I was going to buy that, or whatever. You sound like you're at the casino. No, once you make a decision, that's your decision. Your thing is to say, okay, where do I go from here to get where I want to go? And you're not going to get where you want to go from here to get where you want to go if you're going back there. It's going to just take you longer to get there. So keep it moving, right? Next thing you know, I look around and they're back to like 7 cents a share. I'm like, what the hell happened? They had went through FDA, got to the next level, because FDA can send you back. You go from 2 back to 1, and then 2 to 3, and then your final. And so they got sent back, and then they got sent back, and then they didn't get the approval at all. They didn't meet the criteria to go to the next step. So it's like you have to be aware, and that's why it's good to like do your research. I mean, I research all the time. I love researching. I would research, how Ann has babies. That's how much I love to research. So, okay, moving on. Same thing with Sirius Radio. I had bought Sirius Radio at like 11 cents. That was during a recession that we had back in 2009. I had bought it like 11 cents. I sold it, when I bought it at 11 cents, I sold it at 75 cents, right? I'm like, oh, it's good, right? Talk about kicking somebody in the butt, me, right? And that's why you can't be in the market out of greed or fear, right? If you're scared, you're gonna always like make the wrong decisions, right? And if you're greedy, you're gonna make the wrong decisions. So you have to go in there with a clear head. This is what I want to do. This is what I want to accomplish, and this is what I'm gonna exit, right? Know when to fold them. Now, in order for the New York Stock Exchange to keep up with people who are actually meeting the strict guidelines, they have this thing called delisting, because you can be on the New York Stock Exchange, the NASDAQ, or anything like that, but you can be delisted. If you ever hear the word delisted, that means that, hey, you're not meeting the criteria, we got to kick you over there to over the counter, the bulletin board, right? They want you to meet the guidelines. So when you see something like someone's getting delisted, that means that their stock is going to go under $1 for 29 days or more consecutively. If they go under $1 for 29 days or more consecutively, they have to come up with some unique plans, and we'll go over that, how they work around that as well. Now, every stock, you may hear it called stock, or you may hear it called share. Every stock, a share, has a stock symbol, right? So for example, like Domino's, their stock symbol is DPZ, right? Tesla would be TSLA, Netflix would be NFLX. FICO, FIKO. It's like everyone has their own symbol. And when you go to buy a stock and you don't know the symbol, don't worry. When we go over to your stock portfolio side of it, when we set up your mock portfolio, you will see that if you put Walmart in, they're going to give you the symbol for it. So you'll write Walmart in the search bar and it'll come out with WMT. So don't worry about the symbols just yet. And then once you start learning your own stocks and what you want and what you like, you're going to know your symbols off the bat. I tell you that. You're going to know your symbols off the bat. I know you hear the term diverse portfolio, right? You want to have a diverse stock portfolio. What that means is that you have the stock market comes in different sectors. You have retail, you have pharmaceutical, you have healthcare, you have the auto industry, you have oil, you have different types of sectors within the market. And when they say diversify, which means that if you have $500 to invest, it's not advised to invest the whole $500 in one sector. Like, I'm going to put all of my money in Tesla. You could. It's your choice, right? But then suppose something goes on with the chips or whatever. All that money is tied into that. So it's good to diversify, which means that maybe put $100 in Tesla, maybe put another $100 in pharmaceuticals, maybe put another $100 in oil and gas, healthcare, whatever it is. And then that will help, like if one industry kind of has a bad day or a bad year or whatever, you still have other ones that are working for you. It's like making your money work best for you, right? So we ain't gonna put all them eggs in one basket. Unless you're really sure, unless you did your research, you said, and that's happened before. I've done my research, I'm like, look, I know this is, I'm buying this. And it was a good decision, but it still took research. Don't just go on a whim. I have a whim that tomorrow is gonna go up. Now, we all know buy and sell, right? But do you know what a stock quote is? Give you a second to think about that. A stock quote, all right? A stock quote is how much money that stock is going for at that particular time. Now, when you're watching like your Google Finance and Yahoo Finance and everything, sometimes they're going to have a 20-minute delay, which means that you may say, oh my God, it's finally $230. I'm going to sell. But if you don't look at the time, it's a 20-minute delay. It was that price 20 minutes ago. What is it now, right? You cash out, you're like, wait, that's not how much I was going to make, because you didn't look at the time to see the real time value. Like for me, I use Yahoo Finance and I signed up for real time. So it gives me real time. I love Yahoo Finance, right? I'm not endorsing anyone. No one's paying me, I promise you. But I love Yahoo Finance, but they will have a 20-minute delay if you're on there. But what I have is a real-time account. So just be wary that, you see a price, just make sure that's the actual price for that particular time you want to buy or sell. For example, like say you want to buy Lyft, right? And it's selling for $25.32 a share. You say, okay, I'm going to pull the trigger. Then when you go to pull the trigger for the market rate, it says $27. Like, no, that's not what it says. And that's because if you look at the time, it was probably 10 o'clock when that price was, and now it's 10:20, right? So always balance off your real time quotes. Now, when you look at the stock market, you see red, you see green. We know green means go. We need red means stop, right? We know one's a warning, one's like, hey, go ahead, do what you want to do, right? So in the stock market, you have the same thing. You have red and green, right? And the first thing we're going to talk about is the green. That's what everybody's here for, right? They're trying to make their green. The green is what they consider a bull market. I'm not sure if you've ever heard of that term, but when you hear someone say we're having a bull market, that means stocks are, they flying high. They're just shooting off. They're shooting off, right? So when you hear someone say the bull market, that's what they mean. The market is going green. The market is going up. The price is rising. And the reason they use bull is because when a bull attacks, swiping up. Swiping up. That's what the bull does. It's going to swipe up, child. And we're about to attack you, going to swipe up with them horns. So remember that when you're thinking, when someone says bull market, the bull market is when the price is rising and it's green. Now, when you hear of a bear market, red, that tells you it's a warning, right? A bear market means the market is coming down. That means people are selling. They're selling their shares. Whenever they sell their shares in big amounts or whatever, the market is going to go down. Well, that stock is going to go down, right? And so lots of times for me, like for example, if I have Tesla or Amazon or Google, I'm going to pay attention to what the NASDAQ is doing, because if the NASDAQ is like having a slumpy day, I'm kind of like, I don't know if these guys can hang, alone by themselves. Normally it's one of them that would drag the NASDAQ down or raise the NASDAQ, right? So when you hear of the bear market, think of how the bear attacks. When a bear attacks, the bear swipes down. So when that bear is swiping down, child, it's like either a good time to buy. Because to me, that's when I buy. I buy when it's in the red, right? You only sell when it's in the green. You don't want to, buy when it's in the green. Now, unless you know something's taking off really fast, and you just want to go ahead and get on that train, go ahead and jump on. Almighty me, jump on that train, right? But you don't ever want to like sit a stock and you're watching it's green and red, and then it's green, green, green. You already know it's been red, you're like, why would I buy it when it's higher? So you want to buy it when it's red because it's going to be a lower price for you to get in. You want to sell when it's a higher price, right? So that's the bull and the bear market. Now with the bull and bear market, you're not really buying stocks from, the New York Stock Exchange or whatever. You're buying it from individuals. So you're going to always have a different number of sellers, a different number of buyers. So when you're buying, you're hoping someone's going to sell it to you at that price. That's why normally I would go with the market price, unless I'm like, I'm not paying no more than this for this. And then I'll do a limit, and we'll go over the limit price and the market price later on, right? So it's always a constant battle between the bulls and the bears. The bulls are trying to push the price up, and they're buying. And the bears are trying to push the price down, and they're selling. Somebody's going to come out on top. Even if it's by a couple cents, somebody's going to come out on top, right? So if you just bought a stock, you're hoping that you have a bull market with that stock. And remember, just because you have a bad day one day, if you're buying these stocks for a long term, you're not looking at, Friday, the market went down on Friday. I suck. No, this is for your retirement. This is for the future, right? So what you're doing is you're building a nest egg, right? And so you're getting your basket and you're putting as many eggs you can in that basket, right? Until it overflows. And that's what you want to do, right? So don't sit there and watch it. Once you buy something, don't sit there and watch it every day. Oh my God, I lost 20 cents. Oh my God, I lost $4. Oh my God, I made $8. I think I might sell. Relax, calm down, and ask yourself, why am I doing this? Am I doing this now because I really need the money? Or am I doing this now because I'm scared? Or am I doing this now because I'm being greedy, right? Ask yourself those questions before you go ahead and pull the trigger. Now, when you buy shares, it's the ownership of a company, right? So if you buy shares of Nike, you're part ownership of that company, right? So that's what shares are. Shares are stocks. And so if you buy 100 shares in Nike, guess what? You own part of Nike. You are a shareholder. And every company, every corporation, if you look at the definition of corporation, is to appease their shareholders first. And you have people that are like, oh my God, I need to, this company did this and this company needs to pay more money, whatever. Their main focus, by definition, is to appease their shareholders first. Now, volume. I know I mentioned volatility. Volume is the same thing. Volume shows you the amount of shares being traded at any given moment. And when you're talking about the New York Stock Exchange, you're talking about 1 trillion shares, right? People are buying and selling all day, every day. You know what I mean? And so when you hear the volume, the more volume you have, you're like, oh, something's up. For example, if you have a stock that is normally trading at 2 million shares per day, and then you look at it and that's the average shares, 2 million shares per day. And then you look at it one day and it's like trading 8 million shares, like, oh, what the hell, something's going on. That either means your butt need to be buying or your butt need to be getting out because something's happening, right? And so you want to look at the volume. And a lot of volume means something is giving it momentum. What is that? That's your job to find out, to know what your next move would be. Now, when you purchase a stock, you're going to have different ways you can buy it. We're only going to go over a couple. You have your market and you have your limit. Now, you have stop loss and all that stuff there too. And we'll probably go into that in more detail in a different video. But right now, we're just getting you into the market. And so when you do market, which means let's go with Amazon. Say Amazon's $170. I don't know because I haven't bought Amazon since they split. Say Amazon's $170 a share, right? And you say, okay, you know what? That's a good price. I'm going to go ahead and buy that. And you buy it at $170. $170 market order. That's what they say they want it for. Boom, buy it. You got it. Okay, but let's say you seen it go down to like 150 at some point within the month. And you're like, you know what? I want to catch it when it's 150. I want to buy it when it's 150. That's where I'd be comfortable at. You can do what you call a limit order. A limit order means that they're going to give you a range, a buy and an ask, of how much people are willing to buy and how much people are willing to sell for. And if you have anything like, for example, if you say it was Amazon, it was $170, right? You wanted to go to $150. You're gonna say, I want to do a limit order. I want to buy this, instead of buying it for $170, I want to buy it at $150. You say limit order, and it'll ask you like, how much do you want to pay? Now make sure you're in between your bid and ask, and we'll go over that too. Make sure you're between your bid and ask. I'm going there and say, okay, they're saying the bid is like, the bid and ask is between, let's say 160 and 190. And you're gonna go in there and say, well, I want to buy it for 120. Now you could, and hope that it drops down to that. But be a little realistic if you really want to get it now, but you want to get it at a lower price, and put a limit order for like maybe 150. Put a limit order, and when you do your limit order, they're gonna ask you like, do you want this order to stay in effect all day? Which means that if it comes to 150 anytime that day, it will automatically buy it for you. And limit orders are really good too for people to keep you from watching the market every single minute, especially if you have to work. You don't want to be at your desk like, trying to do your job and you're trying to see if you lost $2. It's like you don't want to do that. And then you also may want to buy something, but you don't have time to sit there and watch the news, do your research all day and see what the analysts are saying. In that case, you would do a limit order. You'll say, hey, when this gets to this certain price, buy it. Now they're going to ask you again, do you want to do it for today? And then the other one is going to ask you, do you want to keep this order in for 30 days? Which means that if it goes down to that price within 30 days, it's going to automatically buy it for you. And you can do the same thing with selling. Let's say you bought something that's 170 and you're like, you know what, I want to get out at 250, right? You can go ahead and do a limit to sell that when it gets to 250, and it'll do it for you automatically. And that'll just keep you from getting like high anxiety and stressing and worrying about every tick up or down, every tick up or down. Trust me, I do that all the time, up and down, up and down. Especially when I didn't sell or buy when I wanted to, then I'm chasing, right? You don't want to do that. Don't be like Lisa, don't be a chaser. Okay, the beta. When I'm buying stock and selling stock, one of the most important things I look at is the beta. The beta tells you how risky a stock is. The beta under 1 is good for like long term. Like if my child, my youngest now is 19, but if she was like 1, I would get things with a low beta because I know it's gonna have a low risk associated with it, and it's gonna grow slowly over time. So I will go ahead and buy those that are safe and just go ahead and build those up. Now, for someone at 58, I don't know about the time thing. We getting a little bit up in age, so I'm trying to go for it, right? So I'm looking for things with a higher beta, because I want a higher reward. Once the reward comes, I want it to be a big one, right? So I'm not sitting there trying to wait 5, 10, 15, 20 years. I want my money sooner than that. So high beta for me. Low beta if you want to be safe, right? And there's nothing wrong with that. You want to be safe, especially when you're starting out. Don't just go in there and being greedy and losing your money, right? Another important note, only put in your market what you can afford to lose. Do not come into the market and people ask me all the time, hey, can you show me what you do? Or hey, can you whatever? And I'll teach it and I'll whatever, but it's not an automatic money maker if you don't put the work into it. It's a lot of work. I mean, like I said, I get up at 6, I'm watching the market. I'm in the market from 9:30 until 4, and then I watch it until 8, and I watch it again at midnight to see what's going on in other countries that are using our market as well, right? And I'm also looking at the CEOs. I'm also looking at what the ownership is. I'm also looking at if they're buying and selling, I'm dumping. Those are all things I'm looking at. I'm also looking at these crazy comments that, regular folk like us are putting in there, because sometimes they do get a buzz. Sometimes in the comments, you will get like a good read on something that's coming down the pike. Somebody might know a little bit of something, but 70% of the time it's mostly like bull crap, right? But hey, I still go and watch that too. So whatever tools you want to use. Now, this may sound complicated, but it's not. Okay, let's go ahead and do this easier. Have you ever heard of a stock split? Remember I was telling you earlier that if a stock is not meeting the standards of the NYSE, New York Stock Exchange, they can be delisted, right? Which means if they're under $1 for 29 days or more consecutively, they can be delisted. Either you guys just break up and go away, or you just go ahead over the counter, bulletin board, pink sheets, penny stock, right? There are two ways. There's a way around that. There's another way if your stock is too high, but you want to get new investors, right? And that's where you have your stock split and your reverse stock split. So let's go over stock split first. For this example, we use Netflix because Netflix has so many stock splits. Netflix is one of the ones you want to get in you wanted to get in a long time ago, right? Because that train just kept moving and it was hard to get back on that train, right? I had to let the train pass me by and I kicked myself in the butt. So with Netflix, let's say Netflix is trading at $400 a share. Let's say you have one share. But Netflix is like, you know what? We want more investors. So how can we make the price cheaper to entice more investors that could not afford the $400 price point? We can do a stock split, right? And so what they're going to do is, say you have one share, $400. It doesn't affect your bottom line, but it does affect the amount of shares you would have. So if they want to do a 2-to-1 stock split, remember the first number is what they're going to give you. The second one is what you're going to receive. So the first number is they're going to give you 2 for every one that you have. So now instead of having just one for $400, you will have 2 worth $200 each. But guess what? Now the stock price is only $200. So guess what they're going to get? A bunch of new investors. Just what they wanted, right? They didn't lose any of the old ones because they already know that once you do a stock split, when the new investors come, they're going to buy it at $200. And next thing you know, it's gone from $200, $205, $215, $220, $225 because the more people are going to buy it because it's cheaper. Which means that now your $400 a share probably is worth now just from the first day of it saying they're going to do a split, probably went from $400 to $500. That can happen, right? Depends on how many people buy the stock. And for example, like I remember a long time ago, I had bought, I think it was Sirius Radio for my aunt. No, it wasn't Sirius. It was something different. But they had a stock split. It did a 10-to-1. So they gave her 10 for every one she had. And so she knew that they were worth $100. So she was like, when she seen the 10-to-1, she got, I have 10 shares. She's like, I'm rich. I'm rich. I'm like, no, you're not. The 10 shares now 10 for 1, which means that each share is only worth $10, right? So you still have $100 worth of shares, but they're $10 each now. And I had to explain it to her. She didn't understand. Like, wait, how come it went? I only had one share and I had $100, and now I have 10 shares. I still only have 100. That's because they did a stock split. Chipotle did like a 50-to-1. For every one, they gave you 50, right? So, which now took their price, used to be like, 3,000 something, and it took their price now down to like, 300, 500, whatever it was, right? And so now they're able to get new investors in who couldn't afford the 3,000 price point because now they're going to give you 50 for every one you have to bring that price down lower and get more people into the market. Helps you out. Now, remember I was saying that if you have a chance that you can be delisted because you've been like less than $1 for 29 consecutive days or more, then you can be delisted. How companies stop from being delisted is what they would do is a reverse stock split. Let's go over that. So you had a company that's going from, they're like 90 cents a share now. It's been like 15 days. They're getting scared. They used to be $1.05, right? But now they're like 90 cents, right? And so they're like, well, I don't want to be delisted, right? I'm meeting the guidelines except for I don't have the, over $1, right? So how can I make this stock where now it's meeting the guidelines? What they would do is a reverse split. So now they're going to do like a 1-2 split. A 1-2 split means they're going to give you 1 for every 2 that you have. So for example, if you had 2 shares for 90 cents each, because now you're like, we're about to get delisted, so how can we work around this? They say, look, what we're going to do with your investors? What we'll do is we'll go ahead and give you 2 shares for every one you have. So now you have 1 share worth $1.80, right? Even though you had 2 shares for 90 cents each, they said, no, for every 2 you have, we're going to give you 1. So now your 2 for 90 cents now is 1 for $1.80. If that makes sense, look at the slide. It explains it better, once you see it. They also happen in different denominations of like they may say we're going to give you a 3-to-1, or they may say we're going to give you a 3-to-2, or they may say we give you a 10-to-1. So stock splits and reverse stock splits are not bad. Sometimes they can be good, right? And I also give an example of a reverse stock split announcement because before they split, they're not going to just come out on Monday and say, hey, tomorrow we're going to split. They normally would say, hey, we're considering a stock split. And they'll tell you like whether it be a 10-to-1 or a 2-to-1 or 50-to-1. And they'll say, for example, if today is, September 24th, they may say our reverse stock split or our stock split goes into effect November 1st. Which means now between September 24th and November 1st, people are buying and selling because they don't know whether to exit or to buy more or to exit or to buy more, whatever, right? So most times, not all the time, but most times when a stock split is coming, people are going to start buying because they can get in at a cheaper rate. Now, reverse stock split, not so much. They're pretty much doing that to keep from being delisted, because you're going to be paying more for that stock. So you can buy now 90 cents. Now you have to buy $1.80, to get a share. So hope that makes sense. Now this last screen is going to be about the stock ticker. And I would advise anyone to just check out CNBC, right? Just look at it, see how the analysts speak, see what they say about the economy, see what they say about, the bull market, bear market, where they see it going or whatever. It's good to find a little show. Like for me, I like to watch, Jim Cramer and David in the morning, right? The Squawk Box. They come on from 9 to 10. I like Cramer anyway. He just makes me laugh. But they'll give you a lot of indications of where they see the market going and why they say that. But when you look at the CNBC channel or any stock screening channel that you have, you're always going to see the same things. Like, let's look at this screen right here. This is a while ago. So they say Apple's record fourth quarter. This means that this is after earnings, right? And so I guess they beat earnings, right? They had a good quarter. Now, if you look below Apple's record fourth quarter, you're going to see something that's called I think it's Eisner Tech. EISS, which is a stock symbol, right? Whenever you see a stock, so this means that now when you look at the ticker, even if you don't hear what they're saying, you can see kind of what's going on in the market. So for example, when you see the little scroll coming by the ticker scroll, you're going to see let's say Eisner Tech. The stock symbol you would know is going to be what's in parentheses, which is going to be EISS. That's a stock symbol, right? Now, the current price is how much? If you want to buy that stock right now, how much is the current price? And if you guess $41, you are correct. It'll be $41. Now, the down arrow means what type of market is it if it's a down arrow? And it's red, right? It's bear, right? So it's going down. So they're telling you that as of right now, at that particular moment, they lost $4. They lost $4 that day. Now they can lose 5, 6, 7, or they can come out at the end of the day being in the green. You never know. That's how much the market fluctuates. So when you're watching it, it's pretty much telling you which stocks are going up. They're going to tell you the name of the company. They're going to give you the stock symbol. They're going to tell you how much the stock is at that current price, and then it's going to tell you how much it went up or down at that particular time. So when you read it, and then the white is normally going to be like your S&P 500, and then your blue is normally going to be things on the NASDAQ. So you have two different colors there. And you can see that day there, the Dow went up 221 points. So most things on the Dow pretty much going to be doing good that day. Doesn't necessarily, you're always going to have a few that will be like, why is the Dow up 300 and this girl goes down 30 points? Really? Right? So, but it gives you a general analysis of where the market is, the things that are listed on that market. So for the NASDAQ, and I'm looking at the little square on the right-hand side, right next to Apple's record fourth quarter, you're going to have the Dow. The Dow, like I said, 221. So Dow's having a good day. Now the NASDAQ, it lost what? 22 points, which is not bad because the NASDAQ averages, a plus or minus, 100 some points every day. It'd be up 100 something or down 100 something or up 200 something or whatever, right? Now when you start seeing the NASDAQ creeping into the 4, 5, 600s, you know that crap is dumping. Crap is dumping. And when you see it going down that much. So today it was, 22 hours. That's not bad. It wouldn't give me any reason to pause, right? That's pretty good for me. The S&P 500, same thing. Now the normal S&P 500, moves between 50 and 100 points. That's still kind of giving it a little bit of grace. But so them just down 15.15, it's not really a bear market per se, right? Not. Even though the NASDAQ is 22, minus 22, it's still not a bear market. You'll see a bear when they're dumping. When you start seeing the S&P losing 100, 200 points, you're like, whoa, wait. You see the NASDAQ losing 3, 4, 5. You're like, wait. You see the Dow losing 3, 4, 5. You're like, wait. What's going on, right? So hopefully you learn some stock terms so that when we go into the next section, you'll understand better. Now, with that, we have a quiz. Ready?